Our guest this week is Mark Peter Davis, managing partner of Interplay. Interplay is a venture capital firm, but also an incubator and family office. Mark himself is a serial entrepreneur and also the host of the Innovation Podcast, which is a great listen for founders. We talked about AI, the mix of geopolitics and startups, what Mark needs to see from startups to invest, why ideas still matter, and advice on how to break into venture capital. Please enjoy. Mark, thanks for coming on the show.
Thanks for having me.
So I thought we could start with a deep, nerdy question, which was, what's a deeply held belief you have about investing in startups?
I think one of the things that maybe I believe that differs, rather than to say something that is commonplace, is I believe companies have to have all of the key ingredients to have a high probability of success. There are a lot of investors that will really be team investors or market investors or tech, arguably barrier investors. I really believe, the things that are going to have real signal for having good outcomes are the companies that have all three. There was a class I took in business school, and it was taught by a couple of really clever VCs in New York. And they had a Harvard Business Review case study. And we read about 3 different companies. And they were anonymized, but they were real companies. And one had a huge market, one had an incredible team, another had great technology. And your job was to pick. And the goal of the exercise was to figure out what kind of investor you are. I don't remember what I picked back then, but venture is a bit like... it's one of those games where you're looking through the windshield, and every time the windshield wipers wipe, you realize that it was foggy before, and now you can see. And then it wipes again, and you realize, wait, I thought I could see, but I was looking through a still foggy windshield. And as I peeled back layers over the years, it's become more and more clear to me, this perspective that you got to have it all.
So you'll never do 2 without the third?
I think it's a high bar.
Common thing I hear from investors particularly around seed, especially pre-seed, is it's founder, 10x founder, also product and market is nice. Do you think that's just an overblown perspective, or is that more something that you think is more true at pre-seed, seed, and less so at Series A?
The latter. I do think there's a pretty compelling argument for that, particularly when companies are identifying product market fit. It's hard to know the size of the market if you haven't figured out what your market is yet. And this is why I primarily invest at A. Series A is my sweet spot, and I like that spot because that is a place where you can start to see signal on all the dimensions.
I was looking at a stat the other day from Wing Ventures that they put together, showed 91% of Series A deals in 2022 had revenue. But if you go back to 2010, that was only 31%. And it got me to thinking about kind of reclassifying fund rounds and names over time. And I'm curious, with Interplay, have you focused more on the label as far as communicating to LPs, we're a Series A firm and we play the game on the field with Series A? Or has it been more, this is the sweet spot of traction and inflection points, and we're just going to invest there regardless of whatever the stage is?
That is a great question. I landed in venture in 2006. So I've been around for a little bit. And back when I joined venture, seed was not an investment category yet. It had not been defined or branded or labeled. The rounds were friends and family, and then Series A. Now, Series A at the time was, still pretty chunky, healthy 7-figure check. But seed wasn't even a category. And it emerged over time. And all of these, through these cycles, as capital requirements have come down, there's been shifts around the milestones that are expected for each of these rounds. And there are constantly moving targets. To put that in context, when companies raised a Series A back when I started, they needed the first $3-4 million just to set up the operation because they had to buy their own servers and hardware. That was before Amazon Web Services was ubiquitous and a reliable option. So the game has changed, and it's usually driven by the capital requirements of venture, which I believe startups are asymptotically approaching the cost of labor in the development side, and now AI is coming after the labor pit. So what the cost structure are now and what they'll be is changing. But no, to answer your question and come full circle, I like what we consider Series A risk profiles of companies. I feel like that's where I can find the signal that I need to have a high fidelity hit rate as an investor. I don't care what it's labeled. If the market evolves and in 3 years it's called a Series B or it's called a Series Seed, I don't care. What I care about is the shape of the opportunity that I feel like I'm dialed in on to generate yield for my investors.
What's the inflection point in the curve in the hockey stick where you feel like you're seeing it the most? Is it? I mean, obviously revenue speaks, but what are the yardsticks that you work off of?
Yeah, I think about investing like stages of building a car. So currently, what I think about for seed is you want to see, or even pre-seed, depending a little bit on the lines, is an engine sitting on cinder blocks. There's no car built around it, but there's an engine where you can put some gasoline in, and you can see fuel efficiency in the businesses we look at. And I think this actually translates, although it's a little bit of a square peg round hole in the calculus, to even enterprise and B2B, is an LTV CAC ratio, right? Understanding the fuel efficiency of the business model. And that's what you kind of see around the Seed Plus. A, you're pouring fuel in the tank and you're going to see the car do some laps and you're going to see kind of how the top speed works. And B, you're going to start seeing that car move to another track and start racing, growth and expansion opportunities. I like the A, but to me, the signal starts when you can see the fuel efficiency of the engine. And then once you see it rev up and rubber on the road and that it can scale a little bit, there's even more proof points in that.
Series E being it's got the Chrome package with the Bose speakers and it's ready for IPO.
Yeah, they've already won the awards and they're already popular at that point.
I want to go back to something you touched on and kept moving, but around AI and labor and developers. My son's been using Replit to build games at home. He's 11. He doesn't know how to code. And I think it's mind blowing and fascinating. And I think, if an 11-year-old who can't code can build something that is probably close to being able to ship, what does that ultimately mean for developers as a career path? And I'm curious how you think about that in a long-term sense of, do you view AI more as a productivity enhancer or threat or some mix?
I think so. A couple of ways to come at this. I had Gary Tan. I was sitting in your seat and I was interviewing Gary Tan, I think yesterday or the day before, CEO of Y Combinator. And I asked him the same question about what he's seeing upstream, because they have a wonderful sample set of the innovation economy going through their factory. And I think his commentary, which resonated with me and feels aligned with my own experiences, is that we are seeing productivity enhancement and a lot of roles already be displaced through the extremity of the productivity enhancement in a litany of areas, not just development. My partner, Kevin, an anecdote, wanted to play around with ChatGPT or Grok, I can't remember which one, just this week, and test its ability to code. So he went on and asked the AI to write a script to create Tank Commander, a game that Kevin had played in the 90s. Not a particularly sophisticated game by today's standards. But in Kevin's words, if he was sitting there coding it on his own, it would take him weeks to create, for sure. 10 seconds later, a script shot out. He ran it through a compiler, and it worked. The game was replicated. So what that means from a coding standpoint is certainly efficiencies are already here, and they should only be exponentially better within a matter of days, weeks, months, years. And I think it's going to have long-term implications for kind of all white-collar career paths. It makes it very hard to be an entrepreneur right now because the short-term strategies that are very interesting may not be durable in the medium to long term. We are at an accelerating rate of change, and charting out the implications of all this is quite complicated. I feel like I've been staring at it for a while and don't have it all puzzled to get pieced together.
Curious if you have thoughts around more white collar jobs there, and I'm probing around venture because I'm a solo GP. For a fund too, it's possible I could hire an associate, but the truth of it is that I've built custom GPTs that are so fantastic, fast, never asked for a raise, never hungover, um, and at a thousandth of the cost of a human employee. I'm almost at a place where it's kind of hard to picture why I would rush out and build out a team. Now I have a different model than you do, but I'm
Right.
curious how you think about venture as an asset class, and maybe kind of the mentoring model and how that might go in a place where you have so many jobs that can easily be replaced.
Yeah, I think there's efficiency gains for sure through all the operational dimensions of venture with the ramping up technology, where it's unclear to me whether the will ever cross over, and if we do, then there's just no role for kind of human decision making at all. So we've gotten to so far into the AI game that there are no jobs. So maybe futile to even debate. But the last bastion where I think there's always going to be a need for trained up, mentored people, from my perspective, unless AI goes all the way, will be the judgment decision making. All of the operational administrative work, the research, the report writing, that can all be delegated now to technology. I think the question is the amount of throughput decision making you as a GB wants to do, and I think that dictates capital base and team size. But I do agree with you that the game is changing and changing fast. I think we're going to see, from a venture perspective, a lot more companies scaling with leaner teams. And what I think that's going to ultimately do to the venture ecosystem from a yields perspective, I think it's going to pull forward value and yield to the earlier stages. So companies that might have gone out to raise a growth round to staff up their sales and marketing to a 50-person team, well, if they're running that through an AI or software driven system to actually do the sales and marketing, I think the value of those rounds are going to accrete to the earlier stage investors who aren't diluted, yet still get to capture the upside on the deals. So I think the bet probably in the medium term is for LPs to go earlier stage. I don't just say that from a self-serving perspective. Actually, I'm trying to crack the code here as an LP as well. And so I think that's where the value is going to consolidate. And then all bets are off if you can make a code with by just whispering into an AI app eventually, and it'll make the app and run the business and do the sales and marketing and run the finances and file the taxes. There's no company and there's no investment community at all. But until that happens, I think the earlier stage is going to be the net winner, and later stages are going to have a tougher time.
In preparing for the show, I went back and listened to an interview you did with Harry Stebbings 10 years ago. It was
Oh boy.
episode 8. That was good. Episode 8 of 20 VC. It was fascinating just to hear the evolution of Harry as a host. Obviously, amazing show. What has changed in your mind about investing in that decade since?
I'm going to draw a longer term pattern trend and propose that the last decade is part of that continuum. I think I was a consultant too many years ago, too many lives ago, and we always kind of try to distill businesses down to critical success factors. And I think success in the beginning of the venture game really came down to three things. Are you seeing the right deals? Are you selecting the right deals? And are you getting onto the cap table? Now, there's some other dimensions to it, helping companies, valuation, all those things matter. But I would say those three were the big three. Till about the turn of the century, I think all three of those mattered a lot. When the century churned and the supply of capital ramped up into the venture community, as it became more accessible, I mean, remember 1980s and before, backing hardware and semiconductors and defense-related funding, it wasn't something that the average consumer could relate to. When the internet showed up, suddenly the products being backed by venture are in everyone's hands, and it became an industry that had social awareness across the board, and that continued to trend. So that drove a lot of capital and adoption into the market. There's obviously great yields to be made. I would argue that in that period, the sourcing and selection remained relevant, but they increasingly were commoditized. VCs were no longer impossible to get to. You could tweet at them. They were promoting themselves via content like this podcast, right? All the things you have to do to be a good GP. It's part of the job. It wasn't the job before the turn of the century. Most VCs were by design invisible. And if you got to them, that was part of the test of whether you're a good CEO or not. The game is very different. And what I think has happened is it's weighted the means of competition in venture increasingly around access to the most competitive deals. When the internet showed up, people didn't know how to value a company. Remember, if for those who were around then, they were valuing companies based on eyeballs and other made up KPIs. And now all of the fundamentals and accounting dimension of a company, that it happens to be an internet company or a software company, fit into a standardized accounting system. So outsiders, non-VCs, non-tech people can evaluate value and risk in these companies. So they're easier to assess, they're easier to find. As a result, the most attractive companies have a line of capital at the door. And the game is increasingly around whether or not you can get onto the cap table and be picked by the entrepreneur. So that is where I think this has evolved to. I think the last decade has kind of been a continuum of that through line. And there's different ways people play in that market and approach that strategy. But that is the dynamic that I think is kind of differentiating which venture firms are generating the most yield.
Anyone who's listened to your show would know that you are geopolitically minded. What are investors overrating right now geopolitically, and what are they underrating?
I think we're talking a lot about the politics of the moment. And I think that's infused in the content stream for everybody. Putting that aside, I would argue that the politics of the moment are part of a larger training continuum. There's a great book that I think anyone who's serious, trying to understand what's going on in the world, should read. It's a book by Peter Zehan, and it's called The End of the World is Just the Beginning. It's a bit of an apocalyptic title. But in that book, he paints a picture that America may be really the first empire to go into a state of decline and then bounce back to the top. Usually empires come and go and they take turns, right? There was the Roman Empire, a whole bunch of others, Ottoman Empire, British Empire, and it's been America's turn for the past 60 years, 70 years. His argument is that we're going to bounce back into a position of strength, not because of our politics or our values, but because of our operations and a lot of luck. It has to do with the waterways, the shape of our landmass, who our neighbors are, the defensibility of oceans on both coasts. It also has to do with resource abundance. So a whole bunch of things that all of us are not talking about when we're talking about the politics of the day. The dynamic that's going on that he paints a picture around is we're entering into a new phase where the U.S. is no longer policing the oceans. And before World War II, it wasn't really safe to ship stuff. Post World War II, America's the policeman of the oceans, and trade and the ports of entry have become robust and a given, commonplace. The watch I'm wearing on my wrist probably came from 20, 30, 40 ports when you count all the little details of plastic and where everything, all the ingredients came from to make it. Peter is suggesting that as America has waned and politically repositioned, the world is going to deglobalize, which it did very rapidly after World War I. And in doing so, the supply chains are going to shift. And instead of trading with Europe and Asia, each block of countries is going to have to be able to trade with neighbors on their landmass, where they don't have to worry about shipping and pirates and the incremental insurance cost or the unreliability of those transports. So I think the world we're entering into is going to be fascinating to watch from a realignment of the supply chain. So particularly for American investors, looking at Mexico as the new China from a production capability, right? And I think all of those macro trends, if you were to say, hey, this has been going on across parties for more than a decade now, we've been on this trend. The idea that the relationships north and south of America are increasingly important. Safety is increasingly important on this landmass. The economic integration is increasingly important. I think it helps to explain a lot of the trends we're seeing in the politics of the day. So I think that's where a lot of opportunities can be born. And I think it's going to be a government priority. And I think it's going to be an economic necessity.
Do you come at investing from a top-down view where you have set themes, ideas, and you're trying to find startups that fit the qualities you're looking for, or are you going at it more from a bottom-up and being informed from some of those high-level views you have?
I have tried to develop a muscle for knowing it when I see it, for being able to dissect the fundamentals of a business in an industry I've never seen before, and find the properties that make something win, regardless of its context. I like to tell people I invest in economic engines. Right? If you look at my portfolio, they're all in the same categories, but it might be a big rig, a golf cart, a pickup truck, if you glance at them. But if you pop the hoods, all of the companies we invest in are the same. They have the same engine inside. And so for me, it's identifying that. There are firms that go out and do the proactive sourcing. We do that at a level, but the reality is it's not the most scalable way to play. And many of the best areas of innovation come from someone's life experiences that aren't experiences you've had. If you've never worked on a farm, you're not going to think about agricultural technology. But someone out there might, and it might have exactly the play that's a great opportunity and has all those economic properties in that engine that you're excited by. So I like to be looking and have frameworks and be open. And I think that paradigm for me has created the most opportunities.
Your show is also, well, you'll veer into geopolitics. It's very founder centric. It's a show for founders. What should founders know about fundraising right now, especially those at the early stage?
I think the headlines are a lot of it's the same as it's always been in some regard. There is a pocket right now of overvaluation. The sector label you would put on that pocket has changed over the years, but there is a pocket now, and there's almost always a pocket. A lot of the other tenets and principles hold, and there's slight changes into the methods and the process. But I wrote a book on how to raise venture capital. It's designed to kind of be a handbook. It's extremely boring, right? I recommend no one read it. Certainly not cover to cover. But it's written to be a handbook with this very robust table of contents up front. So you can flip to page 53 and read the 3 paragraphs about what happens when an investor asks a certain question or at a certain meeting. And I would say that I've thought about at some points updating it. The reality is there's only a couple things in that document that I think have kind of gone by the wayside. One, executive summaries don't play the role in the fundraising process that they played 10 years ago. People just send the deck. And 2, the way I refer to Series A, you probably could replace that phrase with seed now in terms of how to shape and think about the context and expectations around that type of structure. The rest of it's pretty much within the same framework. There's ebbs and flows. I mean, call it 10 major terms that matter in a VC negotiation. And for each of them, there's usually an A, B, and C toggle. One's investor friendly, one's founder friendly, and one's in the middle. And in different market dynamics, those toggles shift, but it's really not that many dimensions to have to navigate. So I would say early stage structuring is fairly simple. So over time, those toggles will shift, but they're the same structures, more or less. So net, I think there is a lot more about it that is the same and has remained institutionalized than has changed.
I saw some data this week that showed that investors' expectations around revenue traction were higher at every stage, which is intuitive and no surprise during a correction when venture investors are a little more gun shy. But interestingly, growth rates, the bar for growth was lower than it was 2 years ago for deals to get done, which felt a little counterintuitive to me. I think the rationale was that investors are more understanding of growth being lower right now just because founders have less capital sloshing around. But I'm curious, what's been your experience on the heuristics that you're seeing for deals getting done?
I think I could propose a concept and what might explain that pattern in the data. I think the revenue requirement at early stages is a logical reflection of lower capital requirements to start a company. When it takes you $3 million to build the app, you're not going to get to revenue. When it takes you 50 grand to build the app, you're expected to get to revenue very early. Growth rates, I would propose, again, these are both hypotheses, that the likely dynamic around lowered expectation around growth rates is that we've exited a period where people were buying growth at all costs, meaning in some extreme cases, companies were buying incrementally unprofitable customers. And there was a slush fund of dollars for marketing and sales. And the goal was to spend as much as you could so you could show a zipping up top line, and investors would come in behind that. When the market corrected, investors came back down to reality and started saying more reasonable things to entrepreneurs, and they acted accordingly, which was by profitable growth. And I think that brought growth rates down, but created healthier businesses as a result. So that would be my gut on both of those trend dynamics. And I think our expectations for company performance is up at every stage if you look over a long enough period of time, 20 years or so. And it's just a byproduct of the capital requirements are getting lower and lower. Fewer engineers to code, less hardware to build on. It's getting cheaper and cheaper to start a company, which is great for innovation and for society. It brings down the barrier to starting.
What's a question you love to ask founders?
Look, I'm an entrepreneur, right? I know I'm sitting in a VC seat. I've been building companies since I was a kid. I probably failed at 12 companies before started building companies at our studio at Interplay. I've got 15 companies under the belt at Interplay that I've started. I love trying to understand the lens they're seeing the business through as operators. They're going to present the venture speak, which is very important. I coach a lot of the founders that I'm partnered with on how to present in that language. But when I'm listening to what they're going through, I'm trying to understand the operational realities. What's giving them stress? Have they figured out how to acquire the customers? Do they understand the psychology of scaling? Something that a lot of people struggle with as they click over from 0 to 1 to going beyond that. For me, I'm trying to the extent I can, get into their shoes as operators and see the dashboard and the world through their eyes. That helps me do more than evaluate the strategic business concept, which I can evaluate from their deck, right? I can read it and think like an investor and draw most of the conclusions I need to draw. When I have the privilege of talking to them and learning, I want to understand what I don't know about the industry or the market. And I want to try to get into their shoes to see if they're thinking the way I think an operator with experience should be thinking.
How do you coach founders you're invested with who think they're struggling a little bit, but you realize they're struggling a lot?
It's hard. I think the key variable is emotional maturity, the extent to which they feel that the failure or success of their business is a personal affront or victory. I really think people need to think of their companies as science experiments. They need to divorce the emotional connection to the business. They need to see failure not necessarily as a bad thing, but a potential outcome. One thing I ask people is, I say, what are you worried about? And it's a very telling question, because either you get a really good answer and you learn something about the inside of the company, or you get a bad answer and you learn about the founder. And those, either way, it helps me help. So I think the headline is doing a lot of listening. But yeah, when you have to have a tough conversation with someone, I always ask people, hey, do you want me, I don't lack empathy for the challenge of entrepreneurship. It's incredibly hard. I've been there. I failed a ton. Do you want me to level with you what I think? I give them a second, prepare. They think about it. Are you ready? Yeah. All right. And then I give them honest assessment about the opportunity and the situation. And if we do it right, if people have the right perspective, it's always humbling. But the more humble you are coming into this journey, the better, because it's hard. You do not know, there is not an entrepreneur in the country who has every skill that he or she needs to build a company. There is not someone who will be successful every go if they keep going at it. So if you haven't run into humility yet, it's going to make an appearance if you keep going at the entrepreneurship cycle.
I read recently that listeners on podcasts, particularly around venture, are much more interested in career advice than comes up on the show. We're always talking about founders and the craft of investing once you're in the game. What advice would you have for someone today who wants to break into investing in startups, but doesn't have a rich uncle or a Harvard degree to lean on to make that happen?
Well, the good news is the opportunity set to get into venture is much broader and wider than it used to be. It used to be there was only one and then eventually a couple cities where you could do this. So if you're in the wrong geography, you were disqualified from the get-go. There were networks of people you were supposed to be connected in with. And I think that is less and less the barrier to entry. I get asked this question a lot and have been since I started in the industry way too long ago. So I recorded a 30-minute talk, which I put on my blog, which I point people to when they ask about it, on how to break into venture. And I run through the different ways to categorize yourself for a venture role, right? Are you coming in as the operator, the VC, the hybrid? How to think about preparing the resume for that. I run through the tactics and strategies for getting in front of investors and how to differentiate yourself. One of the big tips is come bearing gifts. Very powerful when you're getting coffee or meeting with an investor to show up with the deal you're looking at. Whether it's good or bad, you can start to show perspective, engagement, and show that you're integrated in the market. So really the best answer for this question is check out that video because it's 30 minutes of content by itself. And people can find that at mpd.me. They can click on talks. And there's a really cheesy video cover with some clip art of someone ripping apart their shirt. And instead of Superman, it says VC. It's terrible. But that is the video.
Are you that person?
No, it's clip art. That is the video.
It is true clip art. Okay.
But it's an old school. I mean, I think the video is 12, 13 years old now, but I think most of the principles, if not all, still apply for getting the job.
What's a conventional view in venture that you think is BS?
I would say it's not just venture, but broader. The idea that ideas don't matter, and this is kind of touching on what we talked about before. A lot of people will say ideas don't matter. It's all about the execution. And I appreciate what the point of what they're saying is like, look, a good founder will start with a bad idea, realize it's a bad idea, throw it out, and keep working until they find a good idea. Okay. But there are a lot of founders that are really smart, hardworking people working on really dumb ideas that fail. And you can see it. Look at all the very capable people you know as an investor or if you're a founder in the game that are working on things that won't work. Now, maybe they don't understand the methodology, right, of identifying whether an idea is good or not. But I think you need it all. I think venture startups are so hard that to pull it off, and the reason the success rate is so low is because you have to really have all the stars aligned. You got to have great ideas. You got to have good execution. You need help, support, timing, luck, everything. It all goes into it. So I try to, with humility, look at all the opportunities we see and think about what piece is missing. Not just investing in a team or a market or an idea, but how do we make sure we have all of this kind of covered as best we can? Because it's hard out there.
There's a founder listening and they want to get in touch. They want to be connected with Interplay. What's the best way for them to get on your radar?
Yeah, we're an open door. For better or for worse, people don't know what to do with that. I made a commitment to myself, which I'm sure I have failed on more than once, but pretty damn close to holding it up. Back in 2007, that I was going to respond to all the email I received. So I am imperfect as a human for sure, but I am a zero inbox machine. And we've built systems and a team to make sure we can try to live up to that level of accountability. And I think it's respect and integrity, to be honest with you. So it's imperfect, but we have a front door that's open. Anyone can go to interplay.vc. There's a big fat red engage button. You click on that. There is a form. That is not a dead end. That is a real submission that goes to the team and gets real responses. And I believe every person submitting should hear a response at the very least. And there's thousands coming through, but I think we have a very close to 100% success rate. If anyone has an issue with that, like doesn't work or something, definitely hit me on Twitter or anywhere else. I'm at MPD on Twitter. But we do believe it's important to be respectful of everybody at all stages. It's just the right thing to do.
Love it. Well, that's a great way to wrap things up. And in the spirit of that, I really appreciate your coming on the show.
Thanks for having me.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.